Welcome to Equity Matters, Navigating Equity Compensation, a webinar series hosted by Countsy. Today, we will discuss trends in stock plan expensing with Barbara Baksa, Executive Director at NASPP, and Todd Markus, Countsy Chief Accounting Officer. We hope you enjoy this conversation. And Corrine, now over to you.
Well, thanks everybody for joining. I'm excited to have Todd and Barb here. I've known Barb almost my entire career, and I understand, has now been executive director at NASPP for 21 years. So well done. And Todd brings a wealth of experience working with so many, mostly privately held, but also publicly held companies. And this may not be the most sexy topic of the week, navigating equity compensation and stock plan expensing, but there's a lot going on, and I think we're gonna bounce back a little bit between private and public companies, and we'll try to make sure that it's clear when we're talking about which. But let's talk a little bit about what's been going on in stock plan expensing, and maybe Barb, if you don't mind, just like do the 90-second overview for people who don't totally understand what we're talking about here.
Sure. So stock plan expensing, what we're really talking about is how your equity plan affects your company's profitability. So we're not talking about taxes. This has nothing to do with the tax that the employee pays. We're really focused in on your P&L statement and how stock options show, or stock compensation, any type of stock compensation, shows up in that P&L statement. And it's always going to show up as an expense. It's a form of compensation, so it's always going to be an expense in your P&L. But with equity awards, it's a little bit tricky. If you're paying employees in cash, it's pretty clear how you calculate your expense. It's just the amount of cash that you're paying out. But when you're paying employees in stock, it gets a lot trickier to figure out what that expense would be. So we have a whole accounting standard to tell us how to do it. That's ASC 718. It was introduced in 2005. It was actually originally called FAS 123R, and then FASB underwent a whole sort of rejiggering of all the standards called codification, and it got a new name, ASC 718. And under it, equity awards are accounted for at fair value. So the fair value of the arrangement is an expense to the company. And that is determined for awards that are paid out in stock, which is most equity arrangements. That fair value is determined as of the date of grant. So on the date of grant, you look at, what would this arrangement be worth to an investor? If the investor were going to buy this arrangement, what would it be worth? That's the fair value. For full value awards like restricted stock or units, that's going to be the same as the value of your stock. If you're a publicly held company, that's pretty easy to determine. If you're a privately held company, that is a lot more complicated to determine, and there is some guidance from the FASB on how to determine that value. And if it's a stock option or a stock appreciation right, you would use an option pricing model, which is a tool that actually traders use to determine the value of options when they're buying and selling them. There's a bunch of inputs into the option pricing model, and that spits out a value. And then whatever your fair value is for whatever type of arrangement is, that's your expense. You will record that because in general, a general accounting principle is that we recognize expenses as they produce revenue for the company. So once we've determined what that expense is, we're going to recognize it over what's called the service period of the award. That's generally the period over which the award is, the employee is earning the award, because it's the services that the employee performs to earn the award that produce revenue for the company. So we recognize that over the service period. And for equity awards, one of the nice things about the accounting treatment is it's a fixed expense. We determine that fair value on the date of grant, and then it doesn't matter what happens to our stock price from that point forward. That expense is fixed. There can be some exceptions if you've modified it, and if awards are canceled, you don't have to recognize expense for the canceled awards or forfeited awards. But in general, that expense is a fixed amount. So one of the benefits of equity compensation is that it's a form of variable pay. The amount of compensation employees will receive ultimately is dependent on the company's stock price. So it is a way of paying your employees a variable amount, but being able to have a fixed expense for that in your P&L statement, which makes equity compensation pretty attractive for a lot of companies from an accounting standpoint. It's also a non-cash expense, and so even though you have this expense in your P&L, it's not drawing down your cash reserves. So that also makes it a pretty attractive form of compensation for a lot of companies.
Right. So Todd, you work with a lot of private companies, CEOs, CFOs, boards. So, if you listen to what Barb just said, if you're a private company, you're like, look, we're not even profitable. We're not making much revenue. Why do I care about this? I'm not even going to worry about it. What would your response be to that?
Well, I think as Barb pointed out, rightfully, it is a non-cash charge. So if you're focused purely on managing cash flow, and that's kind of the key metric for the company, then maybe this isn't as important. But those awards certainly have value. We all recognize it. It's why employees want things like stock options. They do have value. So measuring that value is important in getting a full picture of what compensation expense looks like. And it's also important, ultimately, if you are a private company moving up the ladder into Series A, Series B, and starting to be subject to audits, confronting that issue and making sure you've recorded stock-based compensation will be a requirement as a part of that. We've also seen it, interestingly, pop up a few times in due diligence activities. So a potential acquirer comes in to the company, and the acquiring entity is potentially a public company that's trying to understand what the uptick in their stock-based compensation expense is going to be. And so they will examine that as part of their due diligence with the target company. Even though for the target company, that was maybe not an important number, the acquiring company is trying to get a sense of sort of pro forma results going forward and understanding and modeling what that stock-based compensation expense piece is going to look like.
Got it. So,
yeah, I'll just add a comment
Yeah.
on that. First of all, if you're a startup and you're not making a lot of money, or you don't have a lot of revenue, you probably don't have a lot of cash either. So having a non-cash form of compensation could be really helpful.
Yeah.
And also, for the startups that I work with, usually, they have big ambitions. Like they have, great hopes that they're going to be really successful and they're going to go public. And the nice thing about paying employees in stock is that if those ambitions work out, which let's be honest, a lot of times they don't, but if they do work out and the company is wildly successful, because the employees own stock, they share in that success. And if you're only paying your employees in cash, you can have a really successful IPO and the employees don't benefit from that at all. So for a lot of startups that I talk to, a part of why they want to offer stock is because they feel like the employees are creating the company, they're contributing to the company's success, and if the company is successful, they should get to share in that.
Right.
I've obviously drank the Kool-Aid when it comes to equity compensation.
I got that. So let's just talk technical for a moment. So Barb, if let's say you're Series A, Series B, like Todd says, you're kind of on the way, you're starting to make money, it looks like you're going to get there. How should you calculate this number? I mean, is this something that you do in a spreadsheet, or what's your thought about getting a system in place? Where your thoughts lie there?
My advice is always get a system in place as early as you reasonably can. Spreadsheets are always dangerous. It's so easy to make a mistake in a spreadsheet, and very quickly, as the company grows and you're granting equity awards, and particularly if you've had some employees around for a while and you're granting them, equity awards on top of the equity awards that they received when they were hired, your spreadsheet can get very complicated very quickly. Especially since it's not, equity award lives for years, because employees earn it over, over usually a period of 3 to 4 years.
Right.
And if you have stock options, they're likely going to be outstanding for 10 years. So you really have years and years of equity compensation sort of layering on top of each other in your spreadsheet. That spreadsheet gets out of control really quickly. And, especially with the accounting, the fair value can be pretty straightforward, but then sort of spreading it out over the vesting schedule gets complicated. And then you have employees leave and you got to figure out what your forfeitures are. And that all can get complicated very, very quickly. And also, the longer you wait to implement an actual, third party solution that's designed to track your equity plan, the more painful that implementation process is going to be. So, do it early on while there are, at this point, there are a lot of great solutions out there. Sorry, I lost my train of thought there. There are a lot of great solutions out there. Many of them are quite affordable for privately held companies. And it's really, my advice is do it do it as early as possible. Don't wait. And someone who worked for me at one point had this sort of horror story of a friend of his who had a startup company, and they didn't look at any of the third party solutions. I guess they didn't really know that they were available, and they paid a consultant to create a spreadsheet for them in Excel, and they paid really I think it was like 70,000. Like, it was an enormous amount of money for this
Wow.
spreadsheet to basically calculate their cap table. And the employee who worked for me was like, why did you do that? There are so many great solutions out there that could do your cap table for you for way, way less than $70,000. So yeah,
Yeah.
get yourself off of a spreadsheet and onto an actual solution as
Yeah,
soon
and
as
that's obviously an
possible.
extreme example, but I used to tell my clients all the time, Excel is never cost effective over the long run, but I've revised that. It's rarely cost effective, even in the short run when it comes to this particular topic for all the reasons that Barb just pointed out.
And your Excel spreadsheet is not going to have any controls built into it unless you build them. So that means you got to know what you're doing to build an Excel spreadsheet that has some controls in it to sort of catch errors and mistakes. Whereas if you use a third-party solution, it should already have they already know what they're doing. They're going to help you, and they're going to have some controls built into it.
Yeah. Yeah, and then we had a situation where there was a CFO who had, of course, the spreadsheet on his own laptop, didn't put it on the cloud anywhere because was very nervous about it, and the CFO died, and we couldn't get into the laptop. So now we had to rebuild everything. So Todd, I'm assuming at Countsy, when you guys are working with clients, that's one of the things that you'll look at. I know you do a lot of different things at Countsy, not just stock-based compensation, but are these the types of things that you help clients figure out that we've got to start putting these things onto the right systems and using them correctly?
Yeah, absolutely. And I think we really aim to do that across the board, not just with topics like stock-based compensation, but getting things out of Excel and trying to automate that better using different cloud tools. So as Barb said, that's a big part of what we help clients do is get that initial implementation done. A lot of companies are already even private companies are using software to some degree to manage the cap table already. So flipping on the switch, so to speak, to pick up the stock-based compensation expense related to what's already reflected in the cap table is sometimes a fairly easy lift. I mean, there is a cost associated with that, but to the degree that the company or their attorneys have already been keeping all of those awards and all of the cap table in that software already, the data is all there.
Yeah.
We just need to turn on the functionality that's going to do the stock-based calculations for us and also calculate all the disclosure requirements that'll be necessary, again, at the point the company gets to where they're being audited.
Yeah. And that's a good point because some people will buy the cap table system, and the cap table really is the ledger of who owns your stock. It's not your stock plan. It'll have a line item on there of how many shares are reserved for the plan. And people then don't go to the next step and say, oh, can you do my stock plan? And then the next step after that, can you do my stock plan expensing? And not all cap tables do that. So when you are shopping, you should kind of ask those questions, what else can you do for me? So
And not all of them do it well. There's some that
yeah.
do cap table management pretty well, but don't do stock-based compensation, the related disclosures very well. So
Yeah.
I would certainly be trying to balance both of those as you evaluate options.
Yeah, and I'm sure both of you be willing to talk to people offline about your experiences.
And if I'm allowed to plug an NASPP webinar, we actually did a webinar last May that where we brought in around 12 different cap table solutions and just had them give like a short 15-minute demo of their solution, and it's free. You don't even have to be an NASPP member; it's free to anyone to watch
Yeah,
it.
you're doing
And
it again this year, right?
huh?
You're doing it again this year in May.
No, I don't know. We're definitely not. We don't have a plan for May. But the recording was on.
Oh, okay. I
So
thought I saw at some point that you guys were doing it, but
no, we don't. We don't currently have a plan to redo it at this point.
okay.
I feel like a year ago, those providers mostly probably still exist. The demos are probably still pretty relevant. We might have to do it again at some point. I'm sure
Yeah,
at some point we'll have to do it again. But that's, and obviously 15 minutes. They can barely touch on their solution. You'd obviously have to do a lot more due
right,
diligence before deciding on a solution. But at least gives you an idea of some of the players that are out there.
right. Well, let's take it one layer even deeper and get a little bit more technical. So, Todd, right now you've got companies who might be thinking about repricing. You've got, kind of the world is blowing up. It is what August 8th today. So, for people who listen to this later, who knows? What would you say from an accounting perspective? Not all the other issues, but around either repricing stock options at your, let's say, privately held company or publicly held company. What are some things you really need to know when it comes to stock-based compensation?
Yeah, well, thank you for not asking me what day should you do the repricing, when will you hit the bottom. So I appreciate that. But on the repricing itself, obviously that's a judgment call the management and the board will need to make on when the pricing should occur. But as Barb explained sort of at the top of the hour here, in theory, the accounting that goes around expensing stock options and similar awards is fairly straightforward. We use a model to kind of come up with the value and recognize that over some service time. The complications, the devil in the details, start to happen when we subsequently modify those initial grants. And so a repricing is a great example of that. Broadly speaking, what we do with a repricing, and even though it legally, the way that might be structured is a cancellation of an old award, issuance of a new award, but from an accounting perspective, we continue to account for the expense that was originally attributed to that old award over its remaining service period, or the service period that the employee is providing services, and then record an additional expense related to the modification that's equal to the difference between the fair value of the new award at the new pricing point and the fair value of the old award immediately before it was modified, which often is some number that approximates zero. So that difference gets picked up and added into what we would normally recognize for stock-based compensation expense. And then the timing of when we recognize that expense depends on whether the repricing only impacts unvested options, in which case it's just going to be an expense we recognize over the remaining vesting term, or to the degree that it impacts vested options, there might be some compensation expense that we would record immediately on the date of the repricing.
Okay. And
But
Barbara,
I have a question on the repricing. So, for public companies, a lot of times what we see is that when they reprice, if they're allowed to reprice at all, which many times they're not, but if they are allowed to reprice, a lot of times the new award that employees have to accept in exchange for the repricing is smaller in terms of the number of shares to mitigate some of that cost. Do you see privately held companies do that, or are they more, do you see a lot of just one-for-one repricings for private companies?
Yeah, it's a great question. I would definitely say it's less common, but not unheard of with private companies where they offer that same thing. It's more of you can take it, here's your deal, keep what you have, or you can have this new one, but it's less. So far less common for private companies, but we do see it every now and then.
Okay.
yeah.
Sorry,
Yeah.
Colleen.
No, that's fine.
Okay.
And I've also seen the vesting really change with the private companies. So you might have been there 2 or 3 years already during the lean, mean times. And now, with the repricing, I have had a few companies say to me too, they just don't want to do it because they feel like if you're a public company, everybody knows what your stock price is doing. If you're a private company, are you raking the bear? Is that are you kind of saying, hey guys, our valuation just dropped significantly, and we're going to make sure that you get taken care of, and the employees start to panic. So I've seen some companies just say we're just going to stay away from it. Just curious, Barb, are you hearing much in the last week with the public company stock prices really being depressed? Are you hearing people jumping on the repricing? I know politically shareholders have not been fans of this whole idea because they're obviously, as a shareholder, taking the ride down, and they feel the employees should as well. But just curious, in the last week or so, if you've heard much from members asking about it.
I haven't really heard anything yet. It sometimes takes a little longer for those questions to filter up to me. So, I'm not sure that a week is enough time for me to have heard anything. Usually people are calling their consultants or their advisors first if they're looking at repricing. I'm
Mhm.
sure those folks have heard something. I was just listening to a podcast yesterday, and I'm like, I guess I have a whole bunch of blogs on repricing. I'm like,
Yeah, probably.
dust out those blogs and get them posted again.
Yeah.
My top advice to companies, and I would say both public or private, is don't reprice too soon. Give it
Yeah.
some time. You don't want to when companies do experience a drop in price, a lot of times there's like this sort of panic, like we got to reprice, we got to do it now. And the worst case, there's sort of two worst case scenarios. One worst case scenario is you reprice and you did it too soon and your stock keeps dropping and then you got to do it again. And, boy, one repricing makes that Excel, first of all, you better have a third party solution if you're repricing because, your Excel spreadsheet's going to get very complicated. And then if you're repricing the same options again, wow, you've really introduced a lot of complexity and potentially a lot of expense.
Yeah.
So you don't want to have to do that. But the other thing you don't want to have happen is you reprice in a moment of panic, and sometimes the markets recover really quickly. Like sometimes there's just some sort of news, and like I think about you know back when COVID first hit, the markets just dropped. But then, like a month later, everyone's stock price was starting to recover. And
Yeah.
if you reprice too soon and then your stock price recovers, then it can look to your investors like manipulation. Like you were just like, oh, hey, we have an opportunity to reset everybody's exercise price and we're going to do it. And that, there's it's just not a good look. There may not be any sort of legal ramifications, but you really don't want to antagonize your investors that way.
Yeah, one thing I'd like to add real quick to something Barb said there is, again, this kind of emphasizes the point of having a good solution in place to help with calculating stock-based compensation. But I would also caution companies to understand that in a repricing or any type of modification of a stock award, that those solutions are not foolproof and they're only as good as the information that goes into them. So to the degree that those repricings or other modifications are not put in correctly in the way that it's set up in the system, we may not get the compensation expense result that we should be getting under ASC 718. And again, it goes back to there's a lot of solutions out there. Not all of them do stock-based compensation exactly right. And we've certainly seen some that have had things like repricing. I had an experience in 2024 with a public company that had run a repricing through their solution. And at the literal 11th hour of trying to file a 10Q, we found a several $100,000 difference in how the system was recalculating that stock-based compensation versus how it should have been recalculated. So use caution going in those. I think that's a great point, a great place to bring in an advisor and just make sure when that gets pushed through the system that we're getting the results we expect.
Yeah, and not all third-party solutions even support modifications or repricing from an accounting standpoint. Like if you're building a third-party solution, you got to make some trade-offs in terms of the functionality that you're creating, and oftentimes the trade-off is, well, we're not going to do the modification accounting.
Yeah.
We don't think it's going to affect that many clients.
Yeah, I think what we're saying is be thoughtful and don't rush into it. There's a lot of different components that you need to think about. I did get asked in the comment section. So Barbara, the webinar is at NASPP.com, and it will be the cap table webinar from last May. So if anybody's looking for it. So Todd, let me ask you another question, because for private companies, there's kind of different things that happen that you don't see with public. So one is the secondary or tender offer secondaries. Let's talk about that. And let's also talk about early exercise, which you see a lot happening more in private companies who tend to grant more ISOs than public companies. So can you just comment on those two? And then Barb, would love to get your reaction as well.
Yeah, absolutely. So it's a great question. And around tender offers in particular, those tend to be a little bit less problematic, assuming it's sort of a pure tender offer where one investor, a group of investors comes in and makes the same offer to acquire shares to all shareholders. Secondary transactions, which I would distinguish as more including just a certain subset of shareholders that are offered the opportunity to sell their shares, can have some compensation consequences for the company. And again, as we talked about at the very top of the hour here, we talk about compensation, we're talking about that from a GAAP perspective under ASC 718. Most of these types of transactions are thoughtfully designed by attorneys and tax advisors to make sure that from the individual's perspective, any compensation or tax consequences of these sales are generally treated as long-term capital gains, not current taxable income. So we're talking about from the company's perspective, when are these arrangements considered compensatory for GAAP reporting? And what we're typically looking at to make that determination are a couple things. The first is the sales price of the stock greater than its underlying fair value? So if you're a private company, you're going to look at a 409A. Is the seller of that stock receiving more or less than what we've identified as fair value under our recent 409A. Importantly, we do see some transactions where the purchase price of the common stock is pegged to the fair value of the preferred stock in a transaction for preferred that is generally happening on or about the same time. That would be a situation where the seller of the common shares is selling their stock for something greater than fair value, at least as it relates to the common stock, because they're selling at a preferred price. So that's the first thing we look at. And assuming the answer is if the answer is no, we're just selling the common stock, or the individual is selling their common stock at the current fair value, then that's really the end of it from a compensation perspective, and we can move on. If, on the other hand, that sales price is greater than the underlying fair value, then we have to start applying a lot of judgment around how or if the company is involved in the transaction. So to the extent that a current shareholder bumps into a potential investor over dinner one night and the two work out a deal for the shareholder to sell their shares to that investor, that probably does not involve the company. But to the extent that the company has reached out to some investors and helped connect those investors with their shareholders, to the extent the company has provided non-public information to those potential investors that are going to buy the shares, to the extent the company is going to change the share rights as part of this, we sometimes see an investor come in, buy common shares from a founder, and then the company agrees to take those common shares and convert them to the latest round of preferred. Obviously, the company is quite involved in that type of transaction. And in that case, generally the way we look at it from a GAAP perspective is as if the company received an investment directly from the investor and then used the proceeds to go buy these shares from the employee at a premium above their fair value, and that premium is compensation expense for the company.
Okay. Barb, anything you want to add to that?
So I guess just a question for Todd. So I know that under ASC 718, there's this mature shares requirement where the employee, if the employee is selling stock back to the company, they have to have owned they have to have sort of borne the risks and rewards of ownership for a period of time, which is usually 6 months. Does that enter into the tender offer accounting at all, or is that not a concern with?
So I'm sure it enters into it. We don't bump into it a lot. Generally, when we see these in secondary transactions, it tends to be, and where the problems tend to be, are founders in particular that have held these shares for a while and have a substantial holding. So there's two things that are generally happening in those secondary transactions. One is there's an attempt to get some liquidity to the founders or the key employees that have been with the company for generally many years. The second is often to help with the dilution that's resulting from a current preferred round. So we got a bunch of new investors coming in, cap table is becoming more diluted. One way to help that is to take out some of the old ownership held by the founders. So it's a little bit of a twofer. It cleans up the cap table and it provides those founders or those key employees some liquidity. But generally, the people that are part of that secondary transactions are ones that have been around for a while. So the 6-month issue, which is a great point, does not tend to come in to play in those types of transactions.
And do you see tender offers when it's something that I run into from our members is, particularly for companies who've been private and they've had to put off an IPO for 9 years, 10 years, like options are only outstanding for 10 years. So a lot of times they're sort of running up on a deadline where they have a lot of options expiring and they're trying to figure out, what do we do? And, now under 409A, you can't extend that expiration date anymore for your stock options. So do you see tender offers used in that situation to help employees not have to have their options expire?
Yeah, that can certainly be one of the factors that are considered. But obviously, when a tender offer is occurring, there's a whole bunch of other factors that are occurring, including the appetite of a new investor to come in and actually acquire all those shares.
Yeah. But that's what happened with Spotify. And literally in the 9th year of the 10th month, they had to pull this together so that people would see something. So you do need to keep an eye on that, especially if your company's older. So we've only got a couple minutes. I just wanted to make sure we answer the question about early exercise, because I've gotten that from a number of people. Does that in any way impact the accounting? I mean, early exercise is obviously something most private companies do provide, especially if they're granting ISO, so people can take advantage on the tax side. But what does it do on the accounting side?
So on the accounting side, to some degree, an early exercise is not considered an equity transaction of any sort, right? Because what's happening in an early exercise is the company is giving shares to the employee that it has a right to repurchase over the remaining vesting term. So we actually account for early exercises as the employee giving money in the form of the exercise proceeds to the company that the company is holding as a deposit liability that they will almost certainly use to buy back the shares if the employee does not fulfill the vesting requirements. So if the employee is terminated, leaves the company is almost certainly going to go back and repurchase those shares. So initially, when an early exercise happens, the only accounting that a company would perform is to record the cash and to record an offsetting liability representing the company's intent to buy back those shares if they are unvested. And then over time, as the underlying shares vest, we release a portion of the liability into equity. So eventually, once those underlying shares fully vest, that deposit liability gets transferred into equity, but it won't happen on the first day.
Got it.
And my guess is the early exercise in most cases doesn't really affect the amount of expense. It doesn't really change the fair value of the award in most cases. And
Yeah, absolutely. That's a great point. Yeah. Expense just keeps being recognized the way that it was set up when the award was originally granted. This has no impact. It's not considered a modification unless early exercise was not part of the original grant, which would be unheard of, I think. It's not accounted for as a modification. It doesn't have any other accounting implications.
Good. Well, that brings us to the end of our half hour. We always try to commit to being very careful with people's time. The talk about secondary offerings and all of that is a great lead into next month's webinar when we have Tom Callanan, who's the CEO of NASDAQ Private Market. He's going to be talking about how these secondaries and tender offers work, why they're so popular and helpful, and we'll get into all of that. So join us on May 13th for that. Want to thank Todd and Barb for joining us today. Obviously, Countsy can provide all these services that we've been talking to, and you can reach out to Todd or anyone at Countsy. And Barb, NASPP's got its big conference coming up in Las Vegas in late September, if I remember.
October 21st to the 24th.
October.
And we will have a whole track of sessions for private companies. So.
Oh, excellent. Good to know. So you can certainly go to NASPP.com to learn more, or Countsy.com. And thanks both of you for joining and sharing your wisdom with everyone. Really appreciate it. Have a good day.
We thank you for joining us, and we hope you enjoyed this webinar with Barbara and Todd. For more information, please scan the QR code for their LinkedIn pages or visit us on Countsy.com. Stay tuned for our upcoming webinars. On the 12th of May, we will discuss the private market and how it can benefit your employees with Tom Callahan, CEO of NASDAQ Private Markets. Please follow us on our LinkedIn page for any updates on the upcoming webinar, and we are looking forward to seeing you at our next one on the 12th of May. From all us at Countsy, thank you again, and have a good rest of your day.